Hello guys, good day and welcome to the strategy video for the New York Opening Range Breakout strategy. This is a very powerful strategy that I'm going to be showing you in this video. All right, so the very first thing to note is that we're going to be using the US 100, which is basically the NASDAQ. That's the asset that this strategy works on best. Now, it doesn't mean you cannot trade it with other assets, but in terms of my back testing and where I've seen to be most profitable, it's on US 100. You can trade this on gold as well. It also works very well. And you can also trade it on other sessions like London session. But the best way to trade this is the New York session. And I'll show you how to do that quickly. So make sure that your time zone on trading view is on UTC -4 or at least on New York. Okay, make sure that's on New York so that you won't miss the time. And if you want to change the time zone, you can change it to convert it to Nigeria. So 9:30 a.m. New York time is actually 2:30 p.m. Nigeria time. All right, so 2:30 p.m. So you see, just about 30 minutes from now, the New York session will open. All right, so that's the first thing you want to do. Make sure you are on US 100. You can do this on MetaTrader 4 as well. And make sure you are on New York time. Now, there's some indicators that I use. Basically, I want the 21 exponential moving average. So I like this colored one, but you can use any one. But it's one of our conditions we're going to use for trade entries. And also, you want to be able to mark 9:30. So let's go to yesterday, which was 24th, and mark the 9:30 point. Okay, so that was 9:30 yesterday. All right. So what we want to do basically is mark the high on the low of the first 15 minutes. Now, this is a 5-minute chart. So 1, 2, 3, that's 15 minutes. So I want to see this range and 1, 2, 3, the lowest point of the three candles. And I just mark that out into the future. Very simple. You can also use a rectangle if you want. Do something like this. All right. When you get the first three candles, or you can go to the 15-minute chart and just wait for the first candle to form on the 15-minute chart, and then you draw your rectangle. It's still going to give you the same thing, but we are going to be trading on the 5-minute chart. So what are we looking for? Let's go back to the strategy. Wait for the 15-minute range to form. You must have patience for this 15-minute range, the first three candles to form, which is what we have right here. All right. That's first three candles. So what's the next thing? Mark the high and low of the range. We've done that. I have indicators that do this for me automatically. So if you are not using the manual strategy, manual lines, just go to indicators and look for ORB. So I have this Lux Algo ORB. I just set it, make sure I set it to 15 minutes here in the settings. Settings is right here. And I put the time 9:30 to 9:45 UTC -4, you see? So it marks the range for me and then it extends the lines for me. Now, what I'm looking for is the first candle to break and close below or above. All right? This one wicked above, so it doesn't count. This is one that closed above. Can you see that? So we'll enter a position after the first 5-minute candle closes outside the range. So basically, we are going to enter a short position. Now, there's something I want to quickly teach you. Is how to score your position sizes, your trades rather. So we can have an A setup, we can have a B setup, we can have a C setup. All right. Now, what is an A setup? We are going to have different time frames and different conditions. We want to look at a higher time frame bias and say, okay, if we zoom out where does price look like it's headed? All right. If you just zoom out like this, you can actually see that, we're actually in an uptrend. And you can use any method you want to use to determine this. Some people like to go to the higher time frame. For example, if you go to the 4-hour chart, let's just scroll there. You can see this is the 4-hour chart. So we're in an uptrend clearly, but you can see here we had a fair value gap. Yeah. Okay. And this was as at yesterday. As at yesterday, we were just, when the market was opening, we were somewhere here, right inside the fair value gap, so we could have, I would have been biased to the top, if I was trading here yesterday. But whichever way you want to do it, if you go to the 1 hour, you can say, okay, look, we had this push up and see these small candles. It looks like, we are bouncing up if we use support and resistance or whatever you use. But the idea is establish the higher time frame. There's a very easy way to also do this. If you are using this 21 EMA, you can actually zoom out to like 3 days. Let 3 days candle show on your chart. So this was yesterday like this. And delete this. So this was Tuesday. This was Wednesday, Tuesday, Monday. So this was about 3 days. Okay. This was Friday. So like this is 4 days. Okay. Oh, this is 5 days. So what we want to look at is, where do you have the most energetic push? Now we have ups, we have downs, we have ups, we have down, we have this downward push, and we have this up push. Which of these moves is the most energetic? Okay. This one looks energetic. This one looks like the most energetic and the longest and the most vertical push. Again, some of you might come and say, I don't know, this looks sideways. No problem. We are just trying to score our position. This doesn't affect the trade we want to take. It only affects the size of position, the risk that we put on the trade. So if I'm going to take this as a neutral trade, for example, or as a long trade rather. I'm going to take it that the bias is up, okay, because of the higher time frame analysis I've done quickly. So the next thing I want to check is at the point where we are breaking out, the 21 EMA, is it pointing upwards or downwards? Okay. At the point where we're breaking out, the 21 EMA is pointing downward. So we have the overall trend is up. We have the lower time, short-term trend is down. So already that rules out an A plus setup. If it's an A plus setup, I must have overall time frame up, the 21 EMA up, and then the breakout up. That would be an A setup. But once I have something like this, where one of it is not correlating, then that would be a B setup. What does this mean? If I was going to risk 1%, normally, if it's an A plus setup, I can risk 2%. Okay. And you see that, or if your normal trade size is 2%, is 1%, you can say, okay, you know what, or if it's a B setup, I will trade 0.5%. And if it's a C setup, I will trade 0.3%. Because I'm not sure, I'm less sure. Maybe the market is just choppy. All right, that's all we're doing for the scoring. Because this strategy has a very high win rate. So we just want to be risking more when we are very sure of direction, because I'll show you what will happen now. All right, so I just wanted to show you the position sizing and the scoring. So what we are doing here is we're going to go with a B setup on this particular trade. So what's the next step? Okay, it says enter position after the 5-minute candle close. So what we do is, again, how do I know where I put my stop loss and my take profit? I already know I'm going to enter short. Okay, now we're going to use TradingView's automatic position tool here. And what I usually do is I make sure that my zoom is calibrated to auto. Can you see that if I double click, it's calibrated, or you can even click here if you're on desktop, auto. It makes sure that when you zoom, everything will be fitted on the screen. So make sure you double click there. It works like that on mobile as well. And then I want to make sure that I have at least 80 to 100 candles showing on the screen. You can take your measurement tool and just measure from where you are and see where, this is 100, this is 101, this is 100 bars. So I want at least this much to show on the screen. It can be more, it doesn't matter, right? Just something like this. And then what TradingView does when you do the automatic position tool is that it takes the average range of all these candles and uses that to form your stop loss. So you don't have to worry, okay, do I put it at the previous high? No, I just take that short. It has calculated the average of all these candles. And when I place it at the close of this candle, at the beginning of the next candle, it automatically gives me my stop loss and my take profit. Can you see that? Let's assume that I zoomed in very close and I do the same thing. You see that, let's assume that I zoomed in and I do the same thing. You see that it gives me a different feel. If I zoom way out and do the same thing, can you see it has accommodated higher candles and the position size has changed. So we want at least the overnight session, at least we want the Asia session to the Asia session to show at least from some like 12 midnight thereabout. Okay, so in this particular trade, you target 1-to-1. That would be a risk to reward of 1, and in about 5 minutes or less, you would have hit your target. Sometimes it goes very fast, just like this, and in 5 minutes you are done, you're out of the trade. You can go back to your business of the day. Some other times the price may actually start going against you, and let's assume it started going against you. This is where you can look to add a second position when it has closed above this 21 EMA. You add that position, and I'll give you some examples of that. But for as per yesterday's trade, this one went straight to profit, and you would have closed your trade here and gone about your business. The other way you can manage your trade, which is what I call dynamic trade management, dynamic money management, is where I don't use a hard stop loss or a hard take profit. In that case, what I would have done, because sometimes price can actually just keep going down like that. All right. And you can end up taking a trade that is this much. Okay. So what you do in that instance is if price just keeps going down, you will just be trailing your stop, marking maybe the previous highs and lows. So when it breaks one high, you can bring your stop down to that side. Okay. And then when it goes down again, you bring your stop until it stops you out. So that's basically how you manage your stop. You can go to the 1 minute time frame. You can actually go to the 1 minute time frame, and you would have been able to do that, which was what I would have done in this case. So you can see when we entered here, price went against us a bit, shut down, created a fair value gap here. Whichever way you like to manage your trades, you would have been able to do this. So he created a fair value gap here. Once he hit this target, I would have taken some money off the table, like 50%. Okay. And then trailed I would have brought my stop. I would have brought my stop to break even somewhere here. All right. I would have put my stop right here as a break even, and then price came all the way back up. Inside this value gap is still acceptable. Once it came down here, all right, I'll probably still have left my stop there, or maybe moved it to the midpoint of this fair value gap, and I would have been stopped out here, altogether. But this is how I would have managed to trade in case it started going down, going down like that, like that, like that. Okay, so that's basically how you enter. How you manage the trade depends on you, really. Depends on you. Some people like to use something called a shelf method, which is where they take the previous swing point, like here, dropped here, went up and came down. So this would have been a swing point here. And then they will put their stop right at the middle of this place. And once price came down, they wait for it to break. Once it breaks here, breaks this point, they'll move this and use this shelf as well. Okay, so whichever way you want to manage the trade, if you don't have time, use the mechanical and just go for your one-to-one like that, one-to-one, and you're out of the trade. Okay, if you have time, you can manage the trade manually. All right, so let me show you another example. Let's look at um Wednesday. Wednesday was a losing day. All right, so let's go to 9:30. Okay, 9:30. So overall trend for me was still neutral yesterday. So I'd have used a smaller position size. And sometimes if you have like I told you about the setups A, B, or C, right? So if you have like a C setup, you can decide, you know what, I'm not going to do any dynamic money management. I'm only going to go for one-to-one. Either it stops me out or I hit my TP at one-to-one. Then for B, I can do dynamic money management and use a smaller position size. And for A, I can use maybe a bigger position size. So you will decide how you want to layer that risk by yourself. But as at yesterday, overall trend was still neutral or up. I believe it was up, yeah, because of that 4-hour fair value gap. So long-term trade was up. We went to let's look at the 5-minute. On the 5-minute chart. So we broke down. So when I zoom out to 100 candles, usually 100 candles is about 1:30 a.m. You can see here, New York time. So you can use your eyes to just eyeball between 1 or 2 o'clock there, and take your short tool, put it here. So you can see that yesterday, if you were doing the traditional, which is the mechanical one-to-one, you would have been stopped out right here for a loss right here because price did not hit your TP. Can you see that? Because this is a B setup, I could have done dynamic money management and said, okay, when we close above the 21 moving average, I will put another trade. Okay, it's going to be the same size there. I would have put another trade. But you know what happens once you put a second trade, your average entry is actually somewhere here. Now, when you have two trades like this, so as price came down to sneak this place, you can see this wick here. Once price came here, you probably would have taken some profit because you would have been at break even there, or you could have actually closed it for a break even trade. Either you close the break even trade or you close one of the trades. Are you seeing that? So you had that option, but let's assume this was just you didn't have time to do that. Okay, this is hindsight. So, and again, your own broker may not really show this. Maybe the week may stop somewhere here, but safe to say that yesterday may have been a losing trade. If I'm using dynamic money management, what I would do is I would have my invalidation zone somewhere around at the top of all these highs here. Definitely outside of the box. Okay, because when price closes above this box, I would know that okay, price has changed direction. So I would have had something like this, but you can see this is an arbitrary zone anyway. That if price reaches here, you know what? I don't want to be in this trade anymore. So price actually wicked up and touched there, even though it came back down. So this would have been a loss yesterday, right? But you hardly lose with this strategy. I'm going to show you some back tests that I've done. This was actually using mechanical. This I logged Okay, so I've been back testing from um last month. That's about a month ago, 20th of June. And you can see mechanical strategy, yes, definitely you have like a 60% win rate or 65% win rate. And sometimes you may get those losing streaks, which you can see here, sometimes two in a row. So all these reds are mechanical. I was basically testing different strategies here, but this is the dynamic money management. So if you are using the dynamic money management, I think I back tested from 1st of July to 24th of July, which gave me about 16 trades or 17 trades now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. And out of these 17 trades, I only have 2 losses. I only have 2 losses. Can you see that? So it's a very, very high, using what I showed you, dynamic money management. If he hits the TP at 1, I will close half of the trade and I would trail my stops. Or if it goes against me, for like all this one that you see 0.6, and trades where it went against me. So I'll give you an example. 4th of July. Let's go to 4th of July. 4th of July. 4th of July. Let's see if it will take us that far. So what happened here was that the price was this 4th of July? Yeah. So we closed above. Oops. We closed above. No, let me zoom out to 100 candles. Let's be accurate. As what I would have done if I was trading on this day. So something like this. Yes. So it should have been a long right here. Okay. So you can see price never reached that place. And by the time it came back here, I entered the trade, immediately went down against me, almost hitting the mechanical stop loss, you see. So, but once it closed below this 21 moving average, I would have entered a second trade, maybe here or here. Are you seeing that? So let's even say I entered after the close of this one, I entered here, a second trade. That averages my entry between here and here. Between the first entry and the second entry, my average entry is now right there. Can you see that? So by the time price came back into profit here, I would have taken some money off the table at break even, all right, and try to manage the trade. So price came back into profit, and it still didn't go back to my previous target, which I was looking for. But you can see that, let's even say I was trying to manage this trade. I have a previous resistance or swing high point here. And once price broke here, I would have moved my stop somewhere here. And see, price just came back and still took me out at this, my um, initial entry. So because of the little I would have taken off at this place here, that's why I put the trade as a 0.3. So most of these 0.3 trades you can see here are trades that you would have lost, all right? But then because of dynamic money management, you came back and you won. Some of the trades you're seeing above 1 are trades that mechanically you would have won. You would have hit TP at 1 hour, but because you trailed your stop, um, you were able to get 1.5, sometimes 2. In this particular month, we haven't seen up to 2, but trust me, there are days where you just do this and you will get like a 4 hour. But you need to have the time, you need to spend time, like 1 hour, sometimes a little over 1 hour to get all that. Okay, so option number 4 was adding to the position if it retraces. I've explained that. You deleverage when price comes back into profit. That's what I just explained. So when the price, goes back and it comes back into profit, that profit zone would be the midpoint of your two entries. And sometimes you may have three entries. It may still come down here, and 1, 2, 3, the average of the three, would show. But how would you know? You will know through your P&L. You will know through all your three trades. When your overall P&L profit or loss is positive, then you know that you've reached your break even. At that point, you can take money off the table. So I hope that makes sense. Okay. The other to trail using support and resistance or swing points. I've taught that. Point 7 is move your stop to break even, that I showed you. Once you see that you're in profit, move your stops to break even to make sure that you do not go back to lose on that trade. And then exit the position if the maximum dollar loss limit is reached. So as I said, I would have an invalidation zone. So if my trade is up, I will have an invalidation zone somewhere outside the box below some of the previous swing points, because price can actually just come down here, take out this point and go back, or it can actually decide to do that. And at which point I would just close for a total loss. So you have to manage your risk dynamically that way. All right. So I hope this makes sense. Some golden rules for the ORB trading. You must have patience to wait the first 15 minutes minimum. We don't do anything until the 15 minutes has passed. After the 15 minutes passes, that's the 15 minutes there. Those three candles, 1, 2, 3. After the 15-minute passes, then we look on the 5-minute chart for the breakout. If you go to the previous day as well, all right, for the first three candles, 1, 2, 3 on the 5-minute chart, that's the 15 minutes, we wait for the breakout. So you can see what happened this day. Your entry would have been here, right here. After this close, I would have entered here. And can you see, I would have trailed the stop. You could have kept trailing your stops all the way up here, maybe stop out somewhere here. All right. So that was my 1.5 or 1.4 hour trade that I did. Okay. So let's look at the last section. We must see a 5-minute candle close above or below. We must define our risk, preferably above the 5-minute high or at a minimum, based on potential loss. So when I'm putting my, for example, invalidation zone, I need to know exactly how much I'm going to lose if price comes down to that zone. Okay, and that's what I will use to know my position size. All right. So we must set our price targets based on risk. Okay, not based on greed, but based on how much am I willing to lose on this particular trade. We must know potential key levels on support. So for example, as I said, I want to put my invalidation zone below the zone and below some recent swing points, and that is also a bit subjective. We must manage our trade based on if we are trading with our own capital or prop firms. So if you are trading your capital, which is what I like and I recommend, I don't do prop firms. Understand, that your position sizing may be different from somebody who is trading on prop firms. All right, because prop firms have their own risk management. All right, they may tell you, okay, you cannot have more than 5% drawdown in a particular day or on a particular trade, or cumulative 6%. They have all these kind of rules, and that would determine how you do your position sizing. So I hope you understand the strategy. We're going to trade this every single day in the Discord. So make sure you join the Discord. If you're not there, follow the link in the description and make your way to the New York ORB trading room. So see you at the bank. God bless.